The biggest investment opportunities, Warren Buffett, don't miss out. Investing in low-cost index funds like the S&P 500 has come to dominate much of the investing landscape over the last 20 years. What's the reason? It is less expensive than most mutual funds. There is much less trading, and the primary structure used to invest in index funds, exchange-traded funds, has tax advantages. Nobody knows when it became clear that investing in index funds has won out over investing in active management, but Warren Buffett declared it was a watershed moment. In today's video, let's hear out the investing rules of Warren Buffett and why he prefers index funds the most. Here we begin. Why Warren Buffett bet on index funds? The wager was that the S&P 500 would outperform a portfolio of 5 hedge funds over 10 years beginning January 1, 2008 and ending December 31, 2017, when performance was measured on net of fees, costs, and expenses. Buffett easily won using the Vanguard Index Fund as a proxy for the S&P 500. Over those 10 years, the 5 funds averaged a net return of 36.3%, while the S&P Index Fund returned 125.8%. Buffett noted the high fees of hedge fund managers in his 2017 letter to shareholders and proposed a simple equation. If Group A and Group B comprise the total investing universe, and Group B is destined to achieve average results before costs, so must A. Whoever has the lowest costs will win. When trillions of dollars are managed by Wall Streeters charging high fees, it is usually the managers who reap outsized profits, not the clients, he advises investors. Instead, low-cost index funds should be used by both large and small investors. Why low-cost index funds could work for you? Buffett said something that savvy investors and traders had known for nearly a century but had taken a long time to permeate the average investor's consciousness. The track record of active fund managers is dismal. For more than 20 years, Standard & Poor's have been tracking the track record of active managers. According to their mid-year 2022 report, when fees and funds dropping out due to poor performance are factored in, 84% of large-cap actively managed fund managers underperform their benchmark after 5 years, and 90% underperform after 10 years. That is so bad that Standard & Poor's stated in a 2019 survey of the results that active managers' performance was worse than would be expected from luck. Why is active management performing so poorly? One issue is that the fees are excessively high, eroding any outperformance. A second issue is that fund managers frequently engage in excessive trading, which compounds investing mistakes and can result in a higher tax bill. A third issue is that most trading today is done by professionals who compete with each other. These traders have access to the same technology and information as their competitors. The result? Most have little to no informational advantage over their rivals. If Buffett, a skilled value investor, sees the value of low-cost index funds, it's also worth investigating for inclusions in your portfolio. Here are Warren Buffett's top 5 investing lessons. Number 5. Time invested in the market is important. Buffett once stated in an annual letter to Berkshire Hathaway shareholders that the only value of stock forecasters is to make fortune tellers look good, and that a smart investor understands that predicting the outcome of a stock is impossible. The non-engineering investor believes that a stock can swing either way, profit or loss, but the prospect of hitting big has drawn many investors to the market. Many market participants were taken aback when the Nifty 50 rose 2.58% or 446.4 points to close at 17,759.3 after falling 1.4% to 17,312.9 on August 29. Today I lost 50 millions. When his portfolio went down the same day, a Twitter user said, "Hopefully I'll recover tomorrow." Buffett's philosophy is that instead of timing the market, you should time your investment through irregular contributions such as SIP and use market corrections to deploy idle cash. Number 4. Invest in yourself to avoid recession. Buffett once stated in an interview with Forbes, "The best thing you can do is to be exceptionally good at something. Whatever abilities you have cannot be taken away. They cannot be inflated away from you. So by far, the best investment is anything you develop yourself, which is tax-free." Buffett believes that investing in oneself and developing career skills can help one stay ahead of the recessions, inflations, and job loss concerns. For example, in February 2022, India's Tata Consultancy Services partnered with NTTF, a technical institute, to upskill over 60,000 people to prepare them for future industry needs. Number 3, it is critical to have cash on hand. Buffett also emphasizes the importance of having ready cash when playing in the stock market. There have been a few times in history, and there will be more times in history, where if you don't have it, you don't get to play the next day, Buffett said in the 2022 Berkshire Hathaway Annual General Meeting. It's similar to oxygen. It's always there, but if it goes away for a few minutes, it's all over. If you save some money, you can take advantage of the opportunities the market presents the next time. Ready cash is also useful in emergency because you won't have to sell your assets to generate funds. Number 2, don't be worried about market crashes. Buffett once said, "Be fearful when others are greedy and greedy when others are afraid." An old Wall Street adage that has two emotions drive markets, fear and greed, underscores his point. When the market crashes, fear reigns supreme, and when the market rises, greed reigns supreme. As a result, Buffett believes that investing in a stock with a high intrinsic value is a good idea. A share, for example, could be down for reasons unrelated to the stock. You might also get a deal on your favorite stock this way. Number 1, believe in long-term stock investing. If you're not willing to own a stock for 10 years, don't even consider owning it for 10 minutes, Buffett said. Buffett's investing strategy has always relied heavily on research. Only invest in a company's stock if its product or services are likely relevant in the next 10 years. Buffett believes that going the extra mile before selecting a stock is always worthwhile in the long run. So, let us know your views in the comments below and subscribe for more.